Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, Thursday, April 9th. What did we learn this week in the equity market? What did we see that jumped off at the page? Has to be the banks. Tremendous action out of the banks, much needed. Difficult for a market to prolong a rally off of dislocations, especially when there's a lack of confidence in credit without the banks getting involved and performing, and even further than that, outperforming the S&P. Very necessary ingredient to a prolonged rally. That's not to say we're at the stage of a prolonged rally, just a necessary ingredient, and we got that this week. That was good to see. What we're looking at day to day and week to week now, from a trading standpoint, is how does the equity market treat securities, be it indices, industries, sectors, stocks, on pullbacks? Are higher lows being created? That's going to be the key for us. We know volatility is going to be with us for a while, even though the VIX is dropped 50% from its high of 2 weeks ago, 2.5 weeks ago. It's still up over 40. A VIX over 40 tells a trader, an investor, to expect continued volatility. We have to use that volatility to our advantage in a couple of ways, and that is having prices that we want to get involved with on the long side, and number two, observing how the markets react to drawdowns during these volatile times. Higher lows are very important to us, much more important to us than higher highs or 200-day moving averages or anything of that nature. We need to see higher lows continue. All higher lows tell you is demand is taking over versus supply. Supply is being wrung out. Supply is starting to dissipate. Important to continue to see these higher lows. So drawdowns, as I said last week and the Friday prior, pullbacks and drawdowns are not something to be afraid of in these markets, as long as demand is there at a higher level than the previous drawdown. So if there's one thing we're paying attention to, it's how are drawdowns treated by demand. So far, so good across all industries. We've seen a number of higher lows. We'll continue to look for that. We'll continue to see if equity markets can shrug off negative news. Very important. What that tells us is perhaps shorter term, the markets have priced in that news. You hear me speak often about equity markets trying to price in news, and that's what we've been seeing. They will always price in the worst case scenario. Perhaps we've seen that. No reason to guess on that. Remain flexible. If you're super bullish here, you're probably going to be disappointed. If you're super bearish here, you're probably going to be disappointed. Trade and invest with your plan. Trade and invest with your allocation. Pay attention to your risk-reward ratios. Everybody stay safe. Have a great weekend, and we'll be back next week.
Hi, I'm John Mousseau. I am the President and Director of Fixed Income here at Cumberland Advisors. It is Thursday afternoon on April 9th. I hope everyone's looking forward to a nice long weekend. We could all use it. A little bit about today, especially in fixed income. Game changer today. Federal Reserve announcing a $2.3 trillion stimulus package from the Fed. Going to help municipal bonds with $500 billion devoted towards buying short-term notes. Think about things inside of 2 years from state and local governments. This includes states, counties, cities, municipal issuers. What will this do for municipalities? This answers the question as we get out of the virus mess. And this question is, how do we pay our bills? This answers the question. They're getting help from the Fed, getting over the hump. This is clearly going to have an effect on longer-term municipal bonds as well, because they will take the cue from the short-term bond market. So we expect to see improvement in short-term municipal debt. We expect to see improvement in long-term municipal debt. And the reason this will help is the fact that so far you haven't seen a lot of municipal issuance come during the last couple of weeks. The deals that have come have gotten good reception. It's clearly at distended levels versus treasuries. Think about a long treasury bond at a 135, and think about a long muni bond roughly at around 3%, which is kind of the middle between 2% where we were before the deluge of bond fund selling hit, and the 4%, which was probably on March 20th, the worst date. We're kind of in the middle right now. But you haven't had any issuance come, and there is issuance coming. This program from the Fed will clearly help the markets. They also provided help for corporate bond markets, and they will start to buy corporate bonds as well. So this is a game changer with the Fed directly getting involved. They're going to even help some of the high yield market, bonds that have what they call fallen angels, that had investment grades but fell off because of this. We think it's an important day, and it adds stability to the markets. It's reflected in the equity markets. We think that really helps. My colleague Matt talked about that. But from where we sit in bond land, we go forward from here knowing we'll probably have some stability in the markets that we haven't had for a while. And we're starting to see less volatility. That's good for issuers going forward. It's good for portfolio managers. It's good for investors because you don't feel like you're making decisions with 50 basis points of volatility following you, which had been more the norm during the last, certainly during the last month. So, good news going into the weekend. Everybody enjoy the long holiday weekend. We'll talk to you next week. Thanks a lot.
Well, we're coming up on a very important weekend. It means a lot to a lot of people. And here we are in the midst of this extraordinary period of history. And we can reflect on the history, think about this particular weekend and what it means to so many in so many ways. We have history that goes back to a plague thousands of years ago. And we have from that a celebration, which was also the Last Supper. So on this weekend, we wish you safety, contemplative consideration of the extraordinary times, and some calm and some peace as much as you can possibly obtain it. Please travel carefully. Please take no chances with this disease. And please be safe.